Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And as you might hear, I've got a bit of a cold at the moment. I just got back from almost 4 weeks of leave. So thanks so much to Campbell for publishing his podcast last week, which was around what we call the 17% super death tax. I thought it was a really good episode, something that's really insightful and something for most people to really think about. Maybe not now if you're far away from retirement or, passing on, of course, and we never know when that's going to happen. But, certainly something if it's not for you because you're younger, something maybe your parents need to think about. Anyway, let's get into today's Q&A episode. And I know we're getting a lot of questions because we can track it now. We've got a different system, almost 30 to 40 per month. So I might threaten to perhaps increase the number of episodes. I don't know if there's a lot of appetite for that, but maybe 3 per week. Let's see what we can do. Anyway, first question is from Zach. Zach writes, "Hi Stuart, I've got a question that could be of interest to younger listeners. I've been a listener for a long time and think your content is great." Thanks, Zach. This question is more for everyday younger Australians who are somewhat starting out and have the fortunate position and they'd like to build on. I'm sure that there's many out there like me and believe your answer could be of great help. I'm 30 years old, just welcomed my first child into the world. My wife and I earned $250,000 combined last financial year. And this financial year, we're down to about $160,000, obviously, because his wife isn't working and he's been doing less overtime. We have a house that's confidently worth $1 million with a $550,000 mortgage and 65 grand in the offset account, no other debt, combined super of 100 grand, and a share portfolio of $95,000. My question is, what are your general thoughts about this kind of situation? What should the focus be over the next 5 to 10 years? I believe we have enough in the offset for a rainy day. Contributing to super is good, but sacrificing the money for 30 years and is maybe not necessarily a great idea. And property investing is not really feasible from a borrowing capacity perspective. Is the best option to keep adding to the offset account until such time we're ready to buy an investment property? It feels like a bit of a grind to get off the ground at the current property prices and interest rates. We're very grateful for a stable position, but of course we've worked very hard to achieve that. And thanks to many books and podcasts for educating us. And Zach writes, just finishes off, for your information, my share portfolio is in a family trust as a corporate trustee, and he realizes he's got a bit of a side hustle going on, realizes it might not be overcomplicating the issue, and just wondering if I had any thoughts. So Zach, I can tell you, I look back over the years and, maybe share portfolios we established 15 years ago where we're really sort of conscious of cost. We want to keep cost and complexity down for clients. More often than not, I regret not establishing an entity. So I think we can easily underestimate, even if we do projections, because we don't really know what the future holds, but we can underestimate, how much a portfolio will grow and what the potential tax benefits could be. So, from that perspective, I'm not against you having that share portfolio in a family trust. You're 30, you're probably going to generate, or, based on your history of managing money well, you're probably going to generate a lot of wealth, and putting that wealth in a family trust makes sense. At least you're not going to look back in 10 years' time and go, well, that was a mess. You're probably going to look back if everything doesn't really work out to plan, I guess, and you haven't been able to accumulate a lot of wealth. So that's just something I share with, the other team members at Pro Solution, is just, that long-term perspective of not being too cost conscious. I know that sounds ridiculous because, of course, we want to keep fees low, we want to keep complexity low, but just generally, as I said, my observation is I've regretted not putting portfolios in structures. Now, there are events in time where you can correct that, and we've taken that opportunity. So, for example, when there's a share market correction, we can move maybe not the whole portfolio, but at least some of the holdings out, and we've done that for some clients. So there's things you can do down the track. As a general rule, I'd probably start out with the best structure first, even if that gives rise to greater cost over maybe the first sort of 5 years, but really talking about long-term investment decisions here. Now, going back to Zach's question, and really everyone in this situation, I've said a number of times on the podcast before that trying to build wealth at the same time as you're establishing a young family is near on impossible, and most people aren't able to do it unless they're on very high income. So they've got one spouse on a very high income. The reality is that there's 2 windows of opportunity to build wealth. It's really before you have kids, and it's got to be quite a few years before you have kids. And then when the kids start going to primary school. So they're the two kind of windows of opportunity. If you miss those two windows, so if you miss the opportunity to build wealth or make some wealth building decisions before you start a young family, then unfortunately the reality is that you've kind of missed that boat. Look, not a big deal. It's not the end of the world, of course. We're only talking about a few years in terms of delay. And in the long run, as you know, you can still do some smart things with your money in the meantime. But I wouldn't feel, if you're in that position, you feel like, look, we're not really taking really a lot of active financial steps to improve our financial position. I wouldn't beat yourself up about it. It is what it is. That's the common situation. So for people in Zach's situation, I mean, the key thing here is, how do we build investment assets? So he's got a great equity position. His home worth about $1 million and net debt of about $500,000. And then super and the share portfolio is to draw a circle around $200,000. So the key question for Zach, if I was in Zach's shoes, is how do I grow that $200,000 investment assets? Because that's the amount of money I'm going to need to fund retirement. And so the best question would be is, how could I grow that into $500,000 or maybe $1 million over the next 10 years? Maybe $1 million could be a bit of a stretch, but still it's a good question to ask. What is the best decision I can make today? So 10 years from now, 15 years from now, that number, that investment number is a lot different to what it is today. And the answer is gear. Borrow to invest. And so I think Zach's touched on that. That's probably the best thing to do. Now, what can you do in the interim? Not much. Really just put cash in offset account. It's going to reduce your non-tax deductible debt, which will increase your borrowing capacity for an investment property down the track, whatever that might be. I wouldn't put it into super because you're locking away for, as you said, 30 years. And whilst it's really tax effective and there's some benefits of doing that, it's too soon to do that. You really want to build wealth outside of super. You've got plenty of time to, add more money into super, and your income's pretty healthy anyway. So you're getting quite a bit of income into super as it is. So I know it sounds really boring, but I would just put all surplus cash in offset account. I'd be maybe inclined to invest in the share market, but only if you were doing that in a way that you felt was avoiding the risks in the market at the moment. Of course, markets are all-time highs, as I'm recording this at the beginning of October. They're at all-time highs, but that's not to say that all markets are overcooked either. So, you might put a little bit in the share market, but I would really probably preserve most of it in the offset account. And that'll allow you then to reduce your home loan mortgage if you need to free up equity and borrowing capacity to go and buy that investment property. And that's kind of the aim. Now, when will you be able to do that? Well, I mean, you've got one child. I don't know what your plans are if you're going to have a second child, but perhaps you could buy that investment property before you have the second child. So maybe your wife returns to work part-time, full-time, whatever it might be, maybe even full-time for a period of time just to increase your borrowing capacity. If you're comfortable, do so, because you've got to think about, what the cash flow impact. Of course, I'm not saying just go and borrow without thinking about those sorts of things. But again, it sounds like you're good at managing money. You've got a buffer. It's really about maintaining those buffers, and that'll help you get through, the period of time if you decide to have a second child. But Zach, that's kind of the approach I would take for anyone there that young, in their 30s, established, already got some investments. It's really about borrowing to invest, because that's going to maximize your returns over the longer term. Okay, next question is from Rob. Thanks for your contribution to the personal finance community. I was wondering if you had any insights into private banking. We're really busy people and would like professional and personal banking service, e.g. timely responses and experienced lenders. Do you have any recommendations in terms of banks? We currently bank with Macquarie. So Rob, it's a really interesting question. Private banking as a product has changed so much over the last sort of 20 years. Private bankers get paid a lot more than traditional lenders in a branch or in a lender. And as a result, they need to generate more profit for the bank. And so you need to really think carefully about that in terms of where will that profit be generated, because you, the client, will be paying that additional profit. So like anything, you can choose features, service, and price. And you can only optimize 3 of those things with any product, right? So you can get something with great features and a great price, but it's typically comes at a cost of terrible service, and so on and so forth. So if you want the features and the service, then you're going to take probably a haircut on the price, that is, pay higher interest rates. Now, private bankers used to be rewarded for selling financial planning services, because you would, and this is going back 20 years, you would go and invest the money and they would charge a commission and they'd earn some good money off that. That doesn't obviously happen anymore. So it's really got to come off the mortgages or any other products that they can sell you. Now, I would say, from my perspective, and of course, I'm answering from the perspective of running a mortgage broking business really since 2002. From my perspective, I reckon a good mortgage broker can still help you. So we deal with the private banks, and so if we feel like a customer suits and needs that level of service, we will do that, and we will do that in a way that's not going to give rise to higher cost. So if we work with the right private bankers, they know that, if we introduce a client to them, that will do most of the work on that behalf. We'll sort of share some of the work in terms of the relationship management. And between the two of us, the broker and the private banker, the client gets a really good experience and a really good outcome. And someone that for example, you can email them and say, this has happened to my account. Can you fix it? Can you open another account? Do those sorts of things. And you can achieve that best outcome. But what you want to make sure is you've got another party there keeping the bank honest, because as I said, there's some pressure there in terms of profitability, and the banks have tried a number of different times on how private banks can work with brokers, and I feel like ultimately they've got to be able to work with brokers because only a handful of brokers will have great clients for them. But anyway, that's my experience. Whereas going directly to a private banker, the bank is going to matter so much as well. It's not just about go to NAB, because it's really banker specific. And that's why, having a broker on your side they're going to do all that work for you in terms of finding who the best bankers are in Melbourne or in Sydney or wherever it is, and help you with that. So that's my view with private bank. Not always necessary, but they do have really good credit criteria, so they can move outside the square, and that's one thing, particularly for high net worth clients, it can be really worthwhile. Okay, next question is from a listener that wants to remain anonymous. This listener has a home in Sydney, no debt, then 4 residential properties and 1 commercial property in Western Australia. So 2 resi in Victoria, 2 resi in Queensland, and 1 commercial in WA. Current value property portfolio 5.3 million, with a LVR around 55%. I think that probably includes the home as well, the 5.3, although I haven't sat down and added up. Anyway, and the strategy that the listener, I should say, not a client, wants to employ is sell a couple of residential properties in the next 2 years, and then buy another commercial property, and then sell the last 2 residential properties in, say, 4 years, and then buy another commercial property. And so by 2029, that'll leave them with 3 commercial properties and a principal place of residence. The people are 40 and 36, don't have kids and don't plan to have kids. Love what they do in terms of working. Wife earns 160, husband 250 to 300, and would like just to maximize lifestyle, things like travel, all those sorts of things. And the listeners asked me to sort of pick it to pieces, if you like. Okay, so where do I start? Let's talk about commercial property. And I recorded an episode recently, episode 371, Beware of Property Spruikers. And I sort of spoke about the trends and fads that have been around, and commercial property is sort of currently a bit of a fad. And I know there's a few sort of prominent buyers agents. In fact, this listener has used one that I'm thinking about, that are out there sort of spruiking commercial property, and they're advertising returns that I just don't think make a lot of sense. Now, they're referencing past returns, past very short-term returns, but doesn't make a lot of sense. Anyway, I've been thinking about this. I've been doing a bit of research, talking to some people. It will probably almost certainly culminate in a podcast episode in the future, but I haven't fully kind of unpacked it yet and completed that research. But my gut feeling is I just don't like it. It just doesn't make sense. Now, let me tell you a story. A friend of mine that runs a commercial property, very large commercial property fund, an investment fund that leases mostly to government. So a lot of their tenants are government tenants. It's a really, really good fund, really interesting fund. Anyway, and he's a friend of mine, so I speak to him a lot about it. They're currently potentially buying a building that is leased to the WA government, and they're going to probably get that at a 8.3% yield or something like that. It's in the eights. That means that's the income coming off the property to a tenant that's a government tenant, which is, you would say, pretty secure, right? I mean, WA government's got no debt and it's in a great financial position. You would say that's almost risk-free, and they're demanding, or the market at least in that space is demanding an 8% yield. So then why am I going out and buying a commercial property in the middle of nowhere in a suburban area, that doesn't have the same tenant profile, has a completely different risk profile? Why are these things selling at a 5 or 6% yield or even 7%? Doesn't make a lot of sense. I can buy a bond from CBA and I'll get 5.5-ish% in terms of yield, completely risk-free. Now, I know you can say, well, it doesn't have the borrowing capacity, that sort of stuff, but that's the sales pitch is, no money down, or you got to actually put 30% deposit in for a commercial property. But the market does not make sense to me in terms of the prices being paid. In a lot of these locations, it's primarily driven by investor activity, and that's an issue, because you want own occupiers out there. You want someone to really be thinking about, well, if I'm going to buy this premises and operate a business from this, what is this asset really worth to me? And how much rent will I be able to pay? And so that market really concerns me. Now, from a strategy perspective for this listener, the listener's trying to chase two rabbits. And the saying goes, if you try and chase two rabbits, you'll probably catch neither. So what the client's trying to do, I keep calling him client, the listener's trying to do is have a property portfolio that's positive cash flow to give himself the flexibility to travel and do all those sorts of things, that's also going to generate capital growth. Now, I have seen commercial property portfolios that have done that. We've got some clients have successfully built substantial wealth using commercial property, but I would say it's the timing that makes the sense, right? If you're getting into the market at an 8% yield, on a building that's leased to government, I would say there's a lot of capital upside there. But if I'm buying something at a 6% yield, that's a completely different asset, I would say I'm not getting enough reward there. I would say the price is too high. So when I look at the clients that have made money, it's an entry point that makes sense. And my wife and I personally owned a commercial property and done incredibly well out of it. But would I buy that asset again today? Absolutely not. Not at its current price. Absolutely makes no sense to me. So I'm not sort of saying commercial property is not a good asset. I just don't think now is the right time in the cycle to buy an asset like that. They're not selling on high enough yields. If those commercial assets were selling at 9% yield or something like that, that sounds exciting to me. But at a 6 or 7% yield, I just don't think there's enough upside. I just don't think you can get enough capital growth from it. And I think it's just not the right time in the cycle to construct a portfolio like that. But what this person needs to do really is think about, and I tried to talk about this in the book Investopoly, is think about asset classes like clubs in a golf bag. Each club's going to do a different thing. You use a driver to tee off because you want distance. You use a putter on the green because you want accuracy. So you want to use property primarily for capital growth. That's fine. And then you want to use other assets for income. So other assets like shares or fixed interest securities provide consistent levels of income. They're income style assets. Property is really a growth asset. Also, they're 40 and 36. So they've got a long runway, hopefully maybe another 40 to 60 years in terms of life to fund. So you don't want to be too conservative either. So you still want to have a substantial amount of growth assets. So if you tilt all to 3 commercial properties and they don't produce the capital growth that you might hope or expect, which I think is a real risk, over an extended period of time, then your strategy is not necessarily going to work as you hope it might. The residential properties that this person owns, I'm not in love with. I haven't looked at them. They're only giving me sort of broad locations, but none of them seem to me or stand out to me as investment grade locations. And I wouldn't have, particularly the Victorian ones, because I know them, I wouldn't have purchased them. And he shared the buyer's agents he used, and I wouldn't have used them either. And I'm not going to share them, who they are in this podcast. I don't think it's right for me to just share my opinion just about one particular business. But, choosing the right people that you seek advice from, incredibly important decision. I hope that's helpful, not only for this listener, but for other people, thinking about commercial property as well. As I said, I promise or threaten to produce an episode about it in the coming weeks and months. Okay, next question is also from a listener that wants to remain anonymous. Thank you for the wealth of information share on the Investopoly podcast. I listen to all 3 episodes every week without fail, including the Holistic Accountant podcast. That's one I do with Mina. And I've been doing so for many years already. Keep up the good work. So thank you very much. I've got a couple of questions that I would like you to share your thoughts on. You mentioned in your podcast it's best to have most of your investments inside super when you retire up to the $2 million transfer cap. We have 3 investment properties between myself and my partner were both 40 years old, assuming we're going to work to 60, 65, when is the best time to sell the investment properties and transfer the gains into super? Do we do this during accumulation phase or after retirement? That's a great question. And let's not forget that transfer balance cap is legislated to be indexed. So by the time you get to, retirement, that it's going to be $2.5 to $3 million in the future. But of course, hopefully your property assets grow over that time as well. It's a difficult question to answer. I think it would be something I would start thinking about in 10 years' time in terms of having a plan on when to divest of the assets. It will depend on the asset's performance as well. Let's assume that you're very happy with the investment property performance. Then it's really, you're going to then think about lending considerations and market timing. So lending considerations will be, can we maintain these loans? Do we have to sell? Like, can we maintain the debt against the property? Now we're talking in 20 years' time. In 20 years' time, obviously inflation kind of eats away at the debt. It's probably not going to be an issue. And I imagine you'll be able to maintain that debt. Then it's about just refinancing onto interest only. But for some people, transitioning into retirement, debt management starts to become an issue, and they might have to sell an asset either the year before retirement or after retirement in order to reduce debt to make the cash flow work from them. I don't think that's going to be necessary in your situation just because you've got such a long runway until you need to do that. The other thing then is to think about is timing around the sales, and you want to have a little bit of flexibility in your strategy because you might go, okay, I'm going to sell this asset, and typically you probably make sense to sell any assets after you retire, if possible, just because you're going to save on capital gains tax. The maximum you can save is about $35,000, maybe $36,000, because that's really the amount of tax that you might pay between 0 and 190,000 and versus the full tax rate at 47%. So you're going to save a bit of tax. I mean, it's a material amount, but it's not going to really, if you've got a massive capital gain, it's not really going to move the dial too much. Having said that, probably better to sell the properties after you retire because then hopefully you'll be in a zero tax position at that time. But you need to keep some flexibility, as I said, because you might say, look, I'm going to sell a property in 20 years' time. So in 2045, I'm going to sell this asset. But in 2045, the market might be terrible. It might be the worst time to sell that particular asset. So you want to make sure that your strategy is flexible enough to be a bit more flexible with the strategy. So in that situation, I would say to a client, okay, our strategy is to sell between 2045 and 2050. For instance, and the strategy works no matter if we sell in 45 or 50 because we've got, we've thought about buffers and super and all those sorts of things. So I would say it'd be great to aim to achieve for my clients, it'd be great to aim to achieve to maximize the transfer balance cap between age 60 and age 70. You don't necessarily have to get it all in there bang by age 60, and we're going to deal with the concessional cap limits as well, and we need to have a strategy around that. So it's really just over that sort of 10-year period, it'd be great to eventually move that money into a tax-free environment. And remember, hopefully we've got a longevity risk to think about, that we're all going to live longer. And when we look at the life tables, the median average age and so forth, let's not forget that half of the people in that data live beyond that. So if I look at and look at I don't know what the age is, but if the median age for someone that was born when I was born is say age 80, at least 50% of people live longer than 80. So you need to think about that as well. And so that's why I think getting money into super, moving it out of the property market into super makes a bit of sense just because of that longevity risk and the amount of tax that you could potentially save over that long period of time. Okay, the second part to this listener's question, we are quite property heavy in our investment portfolio and have hence started investing in ETFs. My partner maximises concessional contributions each year, and I'm also contributing $3,000 a month into VAS and VGS with a 30-70 split. We'll continue to do this for the next 20 years. The ETFs are invested under our family trust. We have two young boys, aged 7 and 9. He's in the highest tax bracket whilst I'm in the 30% tax bracket. What are your thoughts on this strategy and ownership structure? If you think a non-trading investment company may be a better option, or do I divest and sell the shares under the family trust? We're using Vanguard Personal Investor to purchase the ETFs. Are there any concerns with this platform as they're not CHESS sponsored? Thanks for your thoughts. Okay, so I like the strategy. You're going VAS and VGS, it's all market cap indexed. I would say when the portfolio starts to become quite significant, you might be better off getting an advisor to look after it to have better portfolio construction. But for now, it's fine and it'll work well but just something I sort of flag because I've spoken about before many times that, there's different indexing strategies or rule-based investing strategies that are going to perform differently in different markets to accommodate risks and opportunities. So it just helps maximize returns. But anyway, that works completely fine. Don't forget you've got a family trust. You don't really need a company because you can always establish a corporate beneficiary to that family trust, which means it becomes a beneficiary of the family trust and you can distribute any income into that company and then pay tax at 30% and then pay a dividend out in the future, particularly when the boys are 18 and they don't have any other income. So your structure is perfect, and having a non-trading investment company is actually not going to improve it. It's actually going to be worse. So your structure is perfect. It's just you might add a corporate beneficiary in the future if and when you need it. But the way I would see it is that you're in a 30% tax bracket, so distributing to a company is not going to help save any money. That's fine. It won't be, you'll blink before you know it. The boys will be 18. We'll be able to use them as then beneficiaries from the trust. And by that stage, in 10 years' time, 10 plus years' time, the portfolio is probably going to generate some more material taxation outcomes between now and then. Between now and then, probably not that material anyway. So I think it's perfect. I like it. No problem with using Vanguard Personal Investor. You're not chair sponsored. It's okay. Vanguard's, very robust business, very well looked after, good oversight, don't have any issues whatsoever. Anyway, I hope that answers your questions, and thanks so much for listening, and thanks so much for writing in. Okay, next question is from CC. CC writes, thanks so much for the podcast. My partner and I love learning your wisdom. Please keep it up. So thanks so much. He and I have an owner-occupied house with $900,000 of debt plus an investment property with $700,000 of debt, both in Brisbane, both expected to do well over the years. Both properties are currently in joint names, with the investment property close to neutrally geared at an interest-only loan. He's in the top income bracket. I'm in the middle income bracket. Kids on the horizon in the next few years. We're struggling to figure out where to from here. We have an emergency fund built up with 4 months of expenses, now looking to put the additional funds to work. We are open to share investing, another property for negative gearing, but also want to diligently prepare for when we have kids. We have even thought about the idea of family trust as a long-term investment vehicle. Any insights to how you would counsel clients if they were in this situation? So if we go back to the question from Carl that I answered at the beginning, where he was in that, well, not very same situation, but I sort of spoke about there's an opportunity to build wealth before you have kids, and that it doesn't really present again until the kids are into primary school, because that's when expenses normalise, you don't have any childcare, those sorts of things, and also both spouses can return to work, maybe not full-time or possibly full-time, but you recover your income. So CC, you're in that position now, and what you need to do, I don't think 4 months of living expenses is enough as a financial buffer, because what I would be doing or thinking about in your situation is I'd buy another investment property, produce some negative gearing benefits, particularly if your partner is in the highest income bracket, and also then help you get into the market and build that equity. I probably wouldn't do it in Queensland, given you've already got 2 properties exposed to that market. I'd probably do it in Melbourne for all the reasons that I've spoken about in the podcast previously. But I would be really concerned or focused on making sure that decision isn't going to cause you a lot of financial stress in the future when you have kids. And you said it's on the horizon in the next few years, but I guess we don't know when that is. So what I'd like to then do is then work out, okay, if we buy an investment property in Melbourne today, what is that negative cash flow? How much impact will that have on your ability to save and contribute to your buffer already? And then if I have kids in 2 years' time, how much will my buffer be at that time? And I want to make sure they've got enough of a buffer to make sure I can get through the next few years of having kids with a lower income, higher expenses. Now, if I could do those numbers and I became comfortable with it, that's what I would do. But if you couldn't become comfortable with it, well, then unfortunately we might have to sort of play with the purchase price amount, but you probably can get your head around it, I would think. The other thing too is build buffers in the loans as well. So if you go and buy that second investment property, add if it's allowable with borrowing capacity, add another $100,000 or $200,000 of bit of buffer, which means that additional loan funds that you haven't used in redraw. Again, that just as a fallback position, a plan B or plan C. If you then start a family and then you need to fund the negative cash flow of the property through redraw, you've always got that up your sleeve. It's not a strategy that I advocate, but again, as a bit of a fallback strategy to give us the confidence to make a pretty substantial investment decision now in advance of having kids. That's also something that I keep in the back of my mind. At least I have access to these monies, and those monies will then give you time to make a decision. So you might need to sell the property if your circumstances change, but at least you've got a year or two to make that decision. You're not under undue stress. That's what I'd be thinking about in your situation. Don't know the numbers, don't know if it's possible, but it kind of links nicely into your PS because CC's added a PS into the question. The PS is, would absolutely love to ask you if you hit the reset button and found yourself 18 years old again. Oh my God, wouldn't that be great? Yes or no? Still knowing what you know now and knowing the current state of the market, what steps would you implement to build wealth again? And I think I've answered this question previously in the podcast. I think if I look back, I wasn't aggressive enough when I was younger in terms of borrowing. I wasn't conservative. I don't think I was overly conservative, but I certainly wasn't aggressive enough. So if I was 18 today, I would go and buy a property in a good area that was really run down, that needed renovating. I would renovate, so I'd make improvements to that property. I'd probably try and do most of the work myself, just to sort of save on money. But, I would just extend my borrowing capacity to the point where I had indigestion every day. So really work hard, hustle hard to, find a lender that's going to do that. And then kill myself to obviously make those loan repayments and keep up with the debt and so forth, but really gear into a market that's just about take off or already has started to take off, but buy a property that has plenty of upside. So even if the market doesn't take off, I'm going to make some capital improvements to this property. And if I get the timing all wrong, at least in a couple of years, I can sell for a reasonable profit because I've done most of the work myself. Most of the work is cosmetic, certainly not structural. And as a result, will improve the value of the property. So that's what I would do. And I would do that in an area. And when I talk about borrowing capacity and pushing to the limit, I'd do that in an area that's blue chip. I wouldn't compromise. I'm not going to buy a shit property in a shit location. I want to buy a shit property in a fantastic location. And that's why I need to really push on my borrowing capacity to be able to do that. And I think, that's probably, I'm all about long-term returns, right? But if I'm 18, I've really got to hustle to sort of build that wealth. So hopefully I hold that property forever, but it's just a bit of a fallback position because if I really push my borrowing capacity, I might find in 2 years' time I'm really drowning. I need to sell the property. Well, if I need to do that, at least there's an exit strategy there because I've done improvements to the property. So it's not a short-term approach. It's really a long-term approach like I talk about in the podcast, but just really mitigating some risk there. Thanks for your question, CC. I really appreciate it. Thanks for listening. And thanks for everyone's questions that you submit. They're really interesting. I love answering them. And tomorrow, I'm going to talk about wholesale investments and sophisticated investments. Do investors that can access those types of investments, do they get better investment options? Until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.